Today's webinar will be talking about de-dollarization. And the idea here is to just check into this conversation that has been over time being prominent in the world. So Emmanuel, Benjamin, and myself will be doing the presentation. So Emmanuel, Benjamin, and myself work under the International Trade and Development. And Benjamin is also an Adam Smith Scholar program at the Institute of Economic Affairs. So on the next slide, we'll have our outline. And what do we intend to do by the end of the webinar? First of all, is to just check what exactly led to the US dollar being dominant. And then we are going to check the supply and the demand side of that domination. And then we are going to, after checking this, we are going to check into, is the dollar losing its dominance in the world significantly? And then we are going to make some conclusion by asking ourselves, what especially is important for anybody who is concerned about dominance, or what lesson would we learn from the US dollar being dominant in the world? So on the next slide is the introduction. And just to give us an in into the whole subject of de-dollarization. So the US dollar is used both locally, and by locally here meaning the US, and it's also used globally. So whether we are speaking Kenya or any other country, including China and all other countries in the world. So, and in this case, it means it's used by households, it's used by farms, it's used by financial intermediaries like banks, and also governments. So de-dollarization is defined as the significant structural reduction in demand of the US dollar globally. And the reason why here the word significant and structural is important, it's because reduction in the use of the dollar that is brought by cyclical things that are temporary is not necessarily something significant to look into, because that's just normal. And the reason why we emphasize that it needs to be significant, it's by understanding that if it's not significantly losing its dominance, then it's not, the conversation is not necessarily as important or as prominent as it is or considered to be. So before we actually get into this, in the next slide, we ask ourselves, what is the US dollar? It's a currency. So currency is money. So what is the use of money? And remember, we already pointed out that the US dollar is used both domestically in the US and globally. So you might find that some currency do not have so much global footprint, but the US dollar has a large one, which we'll see once the data is start being displayed. So remember, money has three core uses: to store value, it's used as a unit of account, and it's also used for exchange. So money is important or currency is important in this case. And therefore, if you want to check whether de-dollarization is happening, you'll have to ask yourself, is it losing its power as a storage of value? Is it losing its power as a unit of account? Or is it losing its power in terms of the medium of exchange around the world? So these are the key parameters under which we can test de-dollarization, whether it's happening or not. The reason why we take this approach, and the reason why economics take this approach, is to go away from assuming that power is accorded by military prowess and all that, and also getting away from the subject that maybe it's somebody who decides whether it happens or not. So it's the uses that currency or money has that determines whether people accept it or not. And once an acceptance has reached a certain level, maybe above average, then it starts dominating, which the US dollar have been doing. And so our main consideration here is asking, what exactly led to this? How is this progressing over time? Who else is claiming they can be the dominant currency? Do they have it in them to be? And then what exactly would a country like Kenya learn, or what even the US should learn from all this? So at this point, I'm going to invite Benjamin, who will take us through especially the supply side of this conversation. Benjamin?
Thank you all for joining, and thank you for the introduction, Moses. My name is Benjamin, and I'm going to present the first part of this, talking about the foundation of dollar dominance. So first of all, a reserve currency is used for invoicing, settlement, foreign exchange, debt denomination, and clearing. And some necessary conditions for a currency to be a successful reserve currency is it needs to be freely convertible, needs to exist in a large, deep, and liquid financial market, have stable domestic macroeconomic conditions, and a wide network of externalities. This slide demonstrates the dollar's dominance. Oh, sorry, if you go, yes, thank you. This slide demonstrates the dollar's dominance, and it rests on four foundations: size, liquidity, and institutions. So the United States remains the largest economy and the issuer of the largest pool of financial assets. The sheer size of the US economy gives the rest of the world to use a reason to use dollars in the first place. On the top right corner, you can see the graph demonstrating the United States GDP, almost 28 trillion, compared to the next two largest. The second is market depth. US financial markets are larger and more liquid than any other alternative. Investors, governments, and central banks can move huge sums of money in or out of dollar assets with minimal impact on prices. And the US market is one of the few markets that can absorb that volume. Demonstrated is the bond market size. The US bond market is about 40% of the world's bond market, equating to $51 trillion. Fourth, liquidity. Because the market is so deep, dollar assets can be converted into cash or into anything else very quickly and very cheaply. And investors know that they're still getting money. The most important foundation is institutions on the bottom left. Reserve currencies are ultimately built on trust. And so one who holds dollars means that they're trusting the future governments and administrations to honor obligations, ensure that property rights exist, and to avoid undermining the currency. So rule of law, enforceable contracts, and independent courts, and most notably, the autonomous, apolitical, independent Federal Reserve or central bank in the United States. It's the main institution that ensures that. Next slide, please. These are four conditions on the left. These are the conditions that produce a currency that people will hold. So rule of law ensures that laws are applied through legal processes rather than arbitrary decisions by whoever's in power. So for someone who's holding dollar assets, this guarantees that rules around their money won't change overnight. If someone buys a treasury bond in the United States, they know it will pay out because the obligation to do that is forced through a legal process. It's not an official deciding at whim what to do and if they're going to honor a commitment. Second, efficient regulations. These ensure that the financial system is governed and that those rules are actually enforced. So it ensures that those who are holding the reserve currency know that their contracts will be honored and their trades will settle. Third, the main function of limited government is to protect private property. And foreign investors, those who want to buy reserve currencies, are far more willing to hold assets in a state, in a country that cannot simply just rewrite rules or seize assets whenever it chooses without consequence. And finally, free markets, of course, mean that the price of currency as well, are determined by supply and demand and not fixed by the state. Now, the tweet on the right is President Trump threatening 100% tariffs on any country that moves away from the dollar. And this tweet demonstrates that President Trump doesn't understand dollar dominance and doesn't understand where it was built from and how it is maintained. Dollar dominance, going back to Bretton Woods in 1944, is built on trust, which rely on the strength of the institutions. It's not by forcing the world to use the dollar. If a country tries to force everyone to use their currency, they may not have the fundamentals back home necessary to sustain a reserve currency. Next slide, please. The previous slide was about institutions themselves, and this slide is about the legitimate authority behind them. So sovereignty of the people and separation of powers means that the authority from the governed is divided so that no single branch holds it all. These are necessary to prevent against any arbitrary action. Political freedom, leaders can be challenged, citizens' voices can be heard. Citizens can remove leaders for their actions if they diverge from the people's interests. And a currency holder benefits because government that can be voted out, has a reason not to destroy the value of the currency or default on its obligations. And of course, economic freedom, the freedom to transact, own, and price without state direction is necessary. So the thread running through all of these is those that hold power must answer for how they wield that power. So in a system without accountability, leaders may print money with no limit, default without a cost, or not honor their obligations. But the institutions, and especially accountability, ensure that the United States, which holds the largest reserve currency, isn't subject to that. Next slide, please. Now I'm going to talk about the United States, then the EU, and then China, and differentiate a little bit of their systems. In the United States, fiscal and monetary authority are separated. The US Treasury runs fiscal policy, so taxing, spending, and borrowing. And the Federal Reserve, like I mentioned before, is apolitical and independent, runs monetary policy, so the money supply and interest rates. And that separation is really key. It's necessary because in some countries where that body is the same, if that body decides how much to spend, but also controls how much to print, that one single institution may print money to cover their spending, leading to high inflation. And the Fed is independent, so the government can borrow, but it cannot order the central bank to finance its deficits by printing money. So for a reserve holder, really since the beginning of dollar dominance, investors and people around the world have trusted the independence of the Federal Reserve because it's guided by long-term economic data, not by political considerations. That's why recently President Trump, who undertook an aggressive public campaign to attack the previous Fed chair, Jerome Powell, he even stopped short of firing him or taking any real action because he understands that the independence of the Fed is what makes the United States able to sustain its dominance. Next slide, please. Next slide. Thank you so much. The European Central. This is a picture of the European Central Bank. It's held in Frankfurt, and the European Central Bank is notoriously independent and credible. And on the monetary side, it's comparable to the Federal Reserve in the United States. However, the euro still doesn't rival the dollar because of the fiscal disunity in the European Union. The euro is shared by 21 countries in the European Union, each of which borrows and sets its own budget independently, meaning that there's no common European treasury that's backing or that's behind the currency. So when combined, the Eurozone government bond market is around 11 trillion euros, which is huge. It's slightly less than half of the US Treasury market, but still large. But it's fragmented across multiple states with different credit ratings, different political regimes, and different levels of liquidity. So the German bunds, which are notoriously safe and well regarded, account to about 2.5 trillion. However, the market is not nearly as liquid and not nearly as large as the United States is. So the European financial markets remain fragmented on national lines with different tax codes, legal systems, and regulatory standards, whereas the United States' debt gives the investor one single asset, which is the treasury, backed by one government. So the euro, because it has independent monetary institutions, but no unified fiscal treasury or institution, it is unable to match the dollar. A reserve currency needs both, and because it's missing half, it's really not a contender beyond Europe. Next slide, please. This slide, it has a picture of the People's Bank of China. So China, on the first two foundations that I mentioned a couple slides ago of currency reserves, it should be a contender. It's the second largest economy in the world. Its GDP is around 20 trillion, and it has increasingly deep markets. However, the renminbi accounts for less than 2% of global reserves. I think it's hovering around 1.8. The reason for that is the People's Bank of China is not independent. It operates as an arm of the state, and the monetary policy serves the CCP, the ruling party's objectives. So there's no separation of powers, as I was describing in the last three slides. There's no independent judiciary to hold it accountable. And the state council, which routinely does audits and checks to ensure that employees are following the rules that they've been told, they're ultimately accountable to that. So that leaves a foreign investor, a foreign holder of that currency, they have no real mechanism to ensure that their 10-year bond will return with the same value. They can't hold that issuer to account. So in order for the renminbi to function as a reserve currency, it would need to start with the institutions. We need to create institutions that allow for accountability from the people. But also, even beyond that, it would need to halt its capital controls and its management of the exchange rate. Because as it stands now, it's very difficult to move money freely in and out of the country. And so as long as the system remains controlled, foreign actors really can't hold, buy, or sell that currency. And it doesn't even have the structure or the ability to now. Next slide, please. Now I'm going to mention a little bit about what I titled the reality of de-dollarization. This graph here shows the share of foreign exchange reserves by currency coded in color. And there's a lot of rhetoric about the future of the dollar. Much of it is not backed by data, but so the dollar has slipped from about 70% of reserves in 2000 to roughly 57% of reserves today. That is certainly decline, but most of that lost share went to the Australian dollar, the yen, and the Canadian dollar, which are small, and even golds too, which are smaller US aligned economy. The euro hasn't recovered from the debt crisis in 2010, and the renminbi, as I was mentioning, remains below 2%. So even though some countries pursue de-dollarization politically, many of the BRICS countries, they still need dollars to transact because the goods, the commodities, and the goods and commodities they want to buy and the companies they want to invest in are all priced in dollars. So no matter how far they try to move away from the system is still dollar denominated, so they're forced to use it. So the stated intent and the economic behavior are not aligned. The political rhetoric of these countries and actors who say they're moving away from the dollar, it's really far ahead of what the data on trade and payments show. Next slide, please. So as Moses was mentioning in the beginning, there are three functions of money: a unit of account, which is what you price things in, a medium of exchange, what you pay with, and a store of value, what you hold wealth in. And so these figures I have on the screen, these 5 figures, demonstrate that the dollar's dominance leads in all 3 categories. So first, starting with the US is about 11% of world trade, despite being only 4% of the world's population. However, the 4 numbers to the right of that are much larger. And the gap between its trade, its global trade, and the use of its currency in transactions and reserves just demonstrate the dominance. Like the gap between how much the US actually trades, the size of the economy, and how widely used the dollar is shows how powerful the dollar is. So first, export invoicing, 50% in dollars, it's the unit of account. This is what the trade is priced in. And interestingly, most of the deals don't even involve the US at all, because as I was mentioning, commodities and oil, metals, grain, and chips are priced in dollars worldwide. And oftentimes a producer prices their goods in dollars because they don't want to be exposed to local currency fluctuations and an unpredictability, so that they understand that the US dollar is stable, so they price it in that. Second, international payments. 51% of international payments are in dollars. That's the medium of exchange. So the export invoicing, that's like the quoted price, and the international payment is the money actually moving. So the dollar is widely used in both the pricing and the payment of goods, which makes sense. Reserves, 50% of reserves are in dollars. This is the store of value. So central banks most central banks all over the world who hold wealth hold it in dollars, because the very nature of a reserve has to be safe and has to be liquid, and dollars satisfy those criteria. And so many of them buy treasuries because they're the deepest and safest market to buy into. The euro is next, around 20%, but much of that is within the borders of Europe. Finally, foreign currency debt, which is 60% in dollars, is a store of value. It's a claim on one's future dollars, but also a unit of account, because the debt is denominated in dollars. And so borrowers will issue in dollars because lenders want to be repaid in something they see as valuable. And all over the world, one sees $100 bill, that's valuable. They see being paid as in US dollars as being paid in value. So to finish it off, the US is 11% of world trade, but the dollar is the unit of account, the medium of exchange, and the store of value for the world at once. 50% of invoicing, half of payments, 57% of reserves, and 60% of borrowing. So the currency's use is detached from the size of the US economy, and that demonstrates its dominance. Next slide, please. Thank you. This is my final slide, and this is called the dollar trap, or I title it the dollar trap. This might run against one's intuition. But foreign liabilities, so debts, are denominated in dollars, while foreign assets or investments are largely held in foreign currencies. So even if the dollar were to drop, the value of what the United States owes doesn't change because it's fixed in dollars, but the value of what the United States owns, its investments, the value of the US's investments abroad go up because the foreign currency assets are now worth more in dollar terms. So interestingly, a weaker dollar actually could improve the United States external balance sheet. And so despite being a large net debtor, the global demand for assets has continued to rise because even in times of economic turmoil, investors always look for the most liquid, deepest, safest markets they can find, and that is the treasury market, US bond market. So even sometimes US made instability tends to strengthen the dollars. It brings US dollars back into the treasury. That's all for my part, but thank you for listening.
Thanks, Benjamin. Now we look onto the other side, and Emmanuel will be answering the question of what does the demand side, those who are demanding the US dollar, shows, and what is the data showing from that end, and some of the lessons that we can actually get from that. Emmanuel?
Thank you. Thank you very much. So what our colleague Benjamin has demonstrated is the supply of dollars. Where do these dollars actually come from? Where is the pump that floods the market with dollars? Because they have to come from somewhere. And so we enter this chapter looking at the demand side with a glance at how trade balances drive currency supply. So after you have built strong institutions, after you have achieved trust, and after you have understood that this trust can only be achieved through what you might call the respect for the dispersal of knowledge, or the respect for integrity in institutions, not in individuals. What do I mean? The American forefathers that sat down and devised a constitution and then built institutions on top of that constitution that together reflected the idea that a system or rules should be designed to withstand even the worst person's proclivities, the negative proclivities of a group that might want to seize the institutions and driving towards their own ends. That is, in economic parlance, we might talk about institutions that mediate the interactions between economic actors and ensure against a myriad of outcomes, including the outcome whereby economic actors privatize all gains and socialize all losses. So, for example, you have read the book Why Nations Fail or heard economists talk about extractive institutions, and their opposite number, inclusive institutions. So, institutions that are trustworthy are those that are inclusive. Therefore, you cannot achieve this kind of an economy that can pump out a currency that is so trustworthy without inclusive institutions. And that essentially we, the world, both Americans and the rest of the world, consume trust whenever they consume American institutions. And that at the end of the day, when we look at these trade numbers, what do they reflect? They reflect many things. And one of them is that when it comes to preserving one's future, securing one's material gains, everyone becomes extremely interested in placing these gains in places where they can trust that they can come back and use these gains in the future, so they can store value and for the long term. Now, this data shows us that in the year 2021, the European Union enjoyed a surplus, a trade surplus of just under 200 billion euros. But on the other hand, the United States endured a trade deficit. You have probably heard the current American administration talk about its consternation about trade deficits. But you probably might not have known, or perhaps you did, but an important thing here when we talk about dollar dominance is that export or trade surpluses actually vacuum one's currency, and the trade deficits actually increase the supply of one's currency. So the fact that the United States has a trade deficit is actually contributing positively to the supply of dollars. So that is, after those institutions have been built, the existing trade balance, the trade orientation of a country has an important say on the supply of the currency of that country. So thus far, there are no traces of the actions of a mastermind seeking to ensure that the dollar is supplied everywhere. Now, what more about the demand side? So here we have the composition of foreign exchange reserves. This is an aggregate compiled by the International Monetary Fund, the IMF, and just as was explored in the previous chapter, we can see that the US dollar has remained a dominant part of global reserves. Now, on the left axis, you have the big four currencies. Then on the right axis, you have non-big four currencies and the share of global foreign exchange reserves that they take of the total allotment of foreign exchange reserves. What is this saying? This is saying that a number. Oh boy. All right, excuse me. I think I had dropped a call for a second. So the world's central banking authorities report to the IMF on their forex, sorry, their reserve portfolios, and they report and say, this is the size of our portfolio, and these are the currencies that we are holding, and this is the distribution of each currency, the share that each currency takes in our portfolio. And then the IMF takes all this data, aggregates it, and says, and then reports and says, this is how much the world is consuming of different currencies. And so by that aggregate, if you go back to the past and to the year 1995, you will find that the US dollar took more than 70% of the global share of reserves. And that second came the Japanese yen. With about, I believe, 15%. The remaining currency, the sterling pound, the German mark, the French franc, took much smaller shares, almost in that order. But then by the year 2000, the some of these currencies ceased to exist and were replaced by the euro when a number of European countries decided to create, in addition to the customs union they already had, they decided to create a monetary union. What does that mean? They allowed goods and services to flow freely between their countries. They lowered their trade barriers. This is something the East African community is trying to do. And then they said, let's take a step further and give up monetary policy independence and in its place have a shared monetary policy, a shared currency, but retain our fiscal policy independence. What was the result? Different countries can spend on their citizens, on public goods, and on whatever else at the state level that they desire. France doesn't have to listen to Spain when it sets its fiscal policy. If it decides to build their equivalent of our SGR, they don't have to listen to Spain, and they don't have someone in Brussels deciding who gets an SGR, which is what you would have with fiscal union. Imagine for a second someone in Addis Ababa deciding whether or not you, Kenya, deserve an SGR or whether we should instead build a stadium in Botswana. That is what it meant to give up monetary policy but retain control of fiscal policy. And you put that together with the trade balance. So, for example, Germany being a significant manufacturer of motor vehicles had nothing to do with the decision to make to create a monetary union. This was an occurrence or a process that preceded that, and the continued investment in exploitation of Germany's peculiar comparative advantage. So that by the time they decided to create a monetary union, Germany was a huge exporter of motor vehicles to the world. And because it was exporting so many vehicles, we who want to buy, say, Mercedes Benzes or BMWs or Audis or Volkswagens, in addition to their myriad of machine tools, had to look for euros. We had to buy euros somewhere and then spend those euros in Germany and in return get these German vehicles. So that is the major when you look at the architecture between the euro and the dollar, and you see that the dollar has sustained such a high demand over the years, whereas euro's demand, of course, is the second most coveted currency for forex reserves in general, but it's nowhere in the league of the dollar. So the dollar's status, it might have dropped from around 70% in the late 90s, sometimes even, as high as 80%, and dropped down to around 58% in the post-COVID period. And then the euro shot up from its birth to take the place of the mark and the franc, and even exceed them and get it to sometimes around 20% of global reserves, and then hover around at between 15 and 20%. The dollar still remained dominant. Now, the KOFR as an aggregate can be misleading in different ways. Now, one of the most important ways is this. The KOFR can give us the impression that de-dollarization is occurring. My colleague Moses mentioned structure, that we need to pay attention to the structural. demand. Now, if you take a country that is a significant player in the global market for dollars, it's just gobbling up these dollars wherever they are, more so than everyone else has a bigger appetite. And that consider that each country has, they have their size, they can change the size of the portfolio, or they can modify the shares, right? Their preferences between currencies. So I can maintain my preference while changing the size of my portfolio. I can say I always want to hold 30% US dollars, even as I change the size of my portfolio. Or I can also change my preference to say, you know what? In this fiscal year or this quarter or this period, we want to hold less of this currency, maybe fewer euros, and want to hold more dollars. Because countries can make these kind of decisions on their portfolio, these types of decisions can have misleading effects on the COFR. Now, on this chart, we can see that the number of countries that actually increased their holdings of US dollars. So they increased their the amount of US dollars they hold in their portfolios actually rose in that period between 2012 and almost all the way up to almost 2022. And you can see um, a period between 2011 and 2016 when this number did not even decline. So on average, more countries were actually increasing their preference. I mean, the amounts of US dollars that they were holding, right? Let's take an example of a major player in this market, Switzerland. This data is from the Swiss National Bank. And what it shows is that at around 2016, the Swiss National Bank's appetite for dollars just ballooned. So they went from they increased their holdings by almost $300 billion. But in most periods, they held just a few more euros than they did dollars. But first and most important for us, their preference for dollars did not change. It is their overall portfolio of foreign reserves, of currency reserves that grew. So you can see here they move from almost, let's say, the year 2013, they're just under 600 billion. By the year 2015, they're May 2015, they are at exactly 600 billion. By the year 2022, their holdings in foreign reserves are beyond $1 trillion. That's in value. But the dollar amount, although the dollar amount it also increased, the dollar share did not. And the dollar share of their overall portfolio actually was lower than the global average. What did this mean for the global average? The global average was pulled down by Switzerland and by the Swiss National Bank's preferences. So that in the end, we get the impression that now, because Switzerland is a major player in the global currency reserves in that market, Switzerland is actually having an outsized dampening effect on the average for global demand for dollars. So a country like Switzerland will leave us with the impression that the preference for dollars is actually um, falling, whereas it might not be, and that one has to go and get into the details. Um, Now here we have back to the COFR. You can see that the claims on US dollars between 2024 quarter three and 2025 quarter four actually increased. You go from 7 actually 7.4 trillion, 7.3 trillion to just about 7.4 trillion. And then the share of US dollars of overall reserves around the world hovers between, say, 57%, 56 and 57%. So, what else could be occurring? Well, the value of global trade continues to grow. The value of the GDP, the world GDP also continues to grow. Other countries are growing. Some countries are growing faster apace than the United States. And then some of these countries engage in more and more bilateral trade. Sometimes they maintain, most times they maintain exchange denominated in dollars, but sometimes they switch bilateral, different bilateral arrangements. Say, okay, maybe we're going to use a different currency to trade with each other than the US dollar. So the effect is we do see that other currencies are beginning to be more of a feature in total forex reserve holdings of central bank authorities primarily, but the dollar is not quite being seated. Now, the three things that affect the holdings, the most important considerations for holding US dollars are liquidity, the composition of debt according to currency, and the bilateral trade relations. So when we go back to Switzerland, there, uh, and let's compare to Kenya. Switzerland is geographically within Europe, but also engages in much more trade with Europe than it does with, say, the United States. Switzerland is, has its, here we can see that demonstrated need for liquidity. So we can already see just by the virtue of those two factors, it helps explain why they hold almost just as much. The quantum of euros that they hold is almost equal to that of dollars, and most of the time has exceeded their holdings in US dollars. So Kenya, on the other hand, Kenya, whose debt is mostly, the external debt is almost wholly denominated in dollars. Their forex reserves are dominated by the US dollar. This is true of many other countries around the world that are not in proximity to, say, Europe. And now, when we comment on China and ask ourselves about demand for the yuan, right? Demand for yen itself exceeds demand for yuan, but it's barely visible on this chart. This is the Japanese yen. Japan shares institutional configurations with the United States and European countries, the Euro area, but its economy is much smaller than that of Europe. So this might account for why the Japanese yen is not as high demand. Some questions about their capital depth, although very, very significant. It is not insignificant. It's vastly smaller than that of the United States or of Europe as a whole. Remember, Europe's GDP is just about 15 trillion. I think Japan is just under 4 trillion. So there you go. Now, when we look at the demand for US Treasury securities, so that's nations, specifically, we're talking now not about corporations, but central bank authorities, similar institutions, and governments the state as a whole, right? So the central bank and the treasury. Who are the major foreign holders of American Treasury securities? Number one, in the period December 22 in the year 2025. So for most of the year 2025, Japan was the most significant foreign holder of American treasuries, holding to the tune of this is a trillion, just always just above $1 trillion in U.S. treasuries. What does this mean? Where when Americans are financing um, public sector allocations, right? Their fiscal policy. Japan has been one of the most important creditors to the United States, where a country like Kenya must struggle and make a serious effort just to sell a single bond and raise something under $5 billion, and this becomes a significant event. The United States consistently is financed by so many foreign governments, including mainland China, a country that is on the headlines as one of the important proponents of the BRICS in general, a country purported to be setting up its own independent, um, a parallel multilateral system, a country that has urged its friends or the international community to look for alternatives to the dollar, a country that has been a target of the current American administration's tirades about um, or the anger with countries that want to switch to the dollar or de-dollarize. So what do we learn from this chart? Well, for one, when countries and different economic actors speak about de-dollarization, they seem not to be putting their money where their vocal cords are. Because in actual fact, they themselves continue to demand more and more dollar holdings. And we can see here in that 2025, China also increased its holdings of US treasuries. There might not be, whatever one wishes for the dollarization, there might not be the demand for alternatives. Not only is there no demand for those alternatives, they're not being supplied, right? They're not being consumed wherever they are, and no one is producing them. And so when you put these two pictures together of demand and supply, this seems to run counter to the headlines that are daily reported to us about the impending collapse of the dollar. And it also demonstrates that the chief of the American institution and administration should be more confident about the dominance of the dollar than he is. And not only should he be more confident that he might not really have to do much besides preserving these institutions for the next generation. And that finally, those who have tested these institutions might be providing the world more reason to continue to trust them because they have proven themselves under stress. Thank you.
Thank you, Manuel. So in the next few slides, I'm going to be taking us through asking ourselves, especially summarizing what has been spoken about. But more importantly, and this we will see when we'll be doing the conclusion, it's important to note that the dollar did not start dominating because the US was strong, developed, or not. As Benjamin had mentioned earlier, in 1945, when the United States decided to help Europe rebuild after the World War II, it created some goodwill. And then this goodwill has propelled the United States for a while and been acceptable. But remember, when people are talking about their wealth, when countries are talking about their wealth, when people are considering buying goods from abroad or selling their goods from abroad, they necessarily want to do it in currencies that, one, they're assured that their value cannot be undervalued due to political interest, or that it will be available for them to exchange whatsoever. And so this provides some of the foundation under which the dollar dominated. But running through the supply side of the dollar, remember, the supply side here means how much dollars are like the US supplying to the world, and necessarily what factors in the US government are contributing to dollars being supplied. And this is creating the dominance. And one of the things we need to notice that the US budget ran some fiscal deficit. I think as of 2025, the deficit was at about 5.9%. And that means that they have to take debt in order to be able to fund their budgets. And so what this translates to is that both from domestic sources and foreign sources, people have to lend to government. And so since the government is borrowing in dollars, it means there is an incentive by foreigners to hold, to have dollars so that they can use it to actually hold the federal debt from the US. And that's one of the key areas under which dollar dominance is coming into play. Because, well, the US demands to take debt. This debt, they are also taking it from foreigners. And as of December 2025, about 60%, which is 59.9% of it was by foreigners. And that's part of it. But it's necessary to understand that whoever is giving this debt to the US government is taking it as an investment. And so the question here to ask is, why would people trust that by taking your money and give it to the US government, what gives you the assurity that you'll get it back? And that's why the institutional landscape, as Benjamin brought it up, is important to note in this case. Remember, of this 59.9% of the federal debt held by foreigners, including Kenyans, 58% of that is held by foreign investors. So this is not governments, but people, whether it's through banks or through other financial intermediaries, they 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 give their money to the US government. In consideration, they will be given their principal back and interest after a while. So what this shows you is even people themselves trust that by giving loans to the US government, they are sure they'll get their interest and their money back. And that's important because it shows you that the dollars are being demanded even by private foreigners. And so the next thing here is the US contribution of exports. Remember, for you to buy US goods, you need to buy them in dollars. And so the US, which is about 4% of the global population, has a double of that in terms of their global export. They're actually the second largest exporter in the world. And what that tells you is if somebody in Kenya is willing, for example, to buy sneakers from the US, they have to convert their money to dollars to buy that. And that means that there's demand for dollars based on export. And given that the US is a significantly larger relative to other countries in the world exporter, it means that the demand for the US dollar is high on that end. And therefore, the US has, by the US exporting to the world, it creates a supply of dollars. The other thing to note is that of all the US stocks, and this is securities, 20% of them are owned by foreigners. This again means that people from all over the world will need dollars to buy US stocks. The other thing is that 31% of the US Treasury as of December 2025 also held by foreigners. And so all these factors shows you that the stock market in the US, the US Treasuries, including the bonds, the federal debt in the US, their contribution to export in the global market are things that from the US end that contribute to people having to have dollars to do that. And so the moment a country is this significant in terms of how much of their currency is needed by the other people in the world for them to be able to invest or transact with them, it tells you that the more of this, the more the currency is needed and the more dominant it will become. Now, on the next slides, now we ask ourselves, what are countries and people doing on their end that actually brings the dollar dominance? And one of the things you realize, and we can take a case example as Kenya. Kenya holds its international reserve. Remember, international reserves are used to facilitate transaction with the world. So Kenya has international reserve held by the Central Bank of Kenya, and our international reserves are held in dollars. So what does that tell you? That Kenya itself is contributing to the dollar being dominant. How? By holding dollars. So it means the world needs to hold dollars, and there's a reason why they hold the dollars and not any other currency. There's also a reason why they're not even holding them in their local currency. And well, since 1945, when the US decided to help Europe rebuild using the Marshall Plan, countries decided to start holding their reserves in dollars. And the reason they decided to do that, one, it's because of the political and economic freedoms in the US, as pointed out by Benjamin using the institutional framework. And the other thing is that there was also goodwill from the US because the US is a huge contributor to global public goods. We can see the US intervention when there is pandemics, in disease surveillance. We can see that with Ebola. They also help in aid. They are also among the leading countries that extend their hand when other countries are in trouble. So even though the US dollar has lost a part of its share in global reserve, it still have above 50%. So above average of all the reserves that are held in different countries, a majority of those are in dollars. Now, lately there have been some divestment from dollar reserves, and some of this has been brought up by different factors, but most of this is going to gold, as we saw when the current US administration under President Trump decided to slap tariffs on people. Some people decided that was the US dollar was shaky a little and they went to gold. And also we have seen that some countries have started moving into bilateral invoicing. And we've seen this encouraged in Asia and especially with China. And therefore, if a country, for example, when Kenya does a government-to-government arrangement in their oil importation, what it means, then they need to hold currency in different denomination if they're using different currency to do that. And that means that they're eroding holding reserves in dollars. But the other thing to note is that the US dollar and the euro have been dominant in trade invoicing. And by this, we mean if you check global markets, export and importation, you realize that most of the invoices are in dollars. And what that tells you is that people agree, or the world agrees, that the dollar is among the most important currency to use in that. And like we are insisting, this is not arbitrary. People do not sit and decide, okay, we'll just go for the dollar for the sake of it. Like Benjamin pointed out, there are various factors that people consider. Remember, this is people's wealth. This is people hard-earned capital that they're using to trade, to store, or they even invest in so that they can make returns in the future. And so since in the last 2 decades, the euro and the US dollar have maintained about 40 to 50% of all trade invoicing in the world. And what that tells you is, as far as trade invoicing is done, dollarization is not happening. Now, some countries do not, some people have a preference of holding their bank deposit, just the same way you have a bank account and you have deposit there. They prefer to have their deposit in dollars. And this is about 19% in most emerging markets, say for China, Hong Kong, and Singapore. And what this tells you is, outside of the US, some people also would prefer to hold their money not in their local currency, but in the US dollars. And so the other, and this will be the last two under this slide, that cross-border liabilities, this includes things like debt and all that, are mostly done, well, not mostly, but 48% of it is done in dollars. So if, for example, somebody or somebody else outside of the country, most people preferred it denominated in dollars. And there's a reason for that. And one is because, well, the Fed, which is an equivalent of the Central Bank of Kenya, does its job pretty well in price stabilization. So they have low inflation. So your money does not lose value that much. And they make sure that they're within the target, which is 2%. And also, the political landscape in the US is way stable, such that people know that irrespective of hard times or political persons trying to use their interests to push the dollar in whatever direction, that the institution there will fight back and they will prevail. And this has been tested, especially in the last 2 years, 1.5 years when Trump got back into power. He has tried to scare the Fed by calling out the Fed chairman. He issued tariffs, but we saw the court fighting back. We've seen the Fed still maintaining its independence irrespective of that. And what that does is people still have enough trust on the system that irrespective of what political pressure might happen, the institution are strong and independent enough that holding your money or your wealth in dollars will not be eroded. But also it's important to know, because of that it will not be eroded, most countries, when they are borrowing their debt, those who give credit or those who give loans gives it in dollars because of that stability. And so since 2008 financial crisis, about 70% of all foreign loans in the world are actually held in dollars. And so both the supply side and the demand side for the US dollar shows you this, that the world is heavily in need of dollars because of some of the characteristics of the US economy and the US institutions, and also the US goodwill as far as contributing to global public goods, including security, disease surveillance, and all, has enabled people to have more confidence in the US dollar. And therefore, they not only hold a lot of it using their reserves or their bank deposits, but they also use it as a mechanism of exchange and accounting in terms of trade. Now, on the next slide, we are now asking ourselves, is it really, can we really trace de-dollarization happening? Next slide, please. And one of the things we can say, like we checked, the reserves, the US had a very high share of reserves before. Previous slide, please. But now we can see it has reduced, not significantly, but it has reduced, and that's I show that the dollar dominance as far as reserve is concerned has been dropping. But the conclusion here is that de-dollarization is actually not happening. And where we have seen the dollar dominance being eroded, it's insignificant and inconsistent. And so, what are some of these things that are causing this insignificant erosion? One is the US-China constrained relationship. Like Emmanuel showed, China holds its reserves in dollars. It also has a contribution to the federal debt in the US, but they have been reducing that over time based on their relationship. So that's one of the ways the erosion is happening. Number two is that the Chinese government has been encouraged bilateral invoicing, whereby if you're trading with China, they decide we are going to do trade in yuan or in local currency, like we have seen happen with Kenya at some point. But more importantly is to realize that the dollar strength is heavily backed by the US economy, the US political, social, and economic freedoms, and just its economic size and the strength and the independence of its institution. And so the person who holds the power, or the place that holds the most power as far as de-dollarization is concerned, is the US itself. If it erodes its own institution, if it goes against principles of free trade, limited governments, property rights, then it has more power to destroy its own dominance than others have. And therefore, you can realize that when the US administration decided to arbitrarily slap tariffs on other countries, that some countries started looking for alternatives. And also some sanctions, the wars that have been happening around, and also when the current administration in the US decided to attack the Fed, there was a bit of shakeup because people would not want to risk their wealth by placing it or investing it in economies they cannot trust. And therefore, it's important that once the US administration are adopting to certain behavior, that they are aware that if they erode the confidence that is built on their strong independent institution, their political stability, and the economy, then their dominance will, without necessarily any intervention from powers or political decision, it's going to erode over time. But another thing that is likely to cause de-dollarization is just the rise of others. Remember, the US dollar is as strong or as dominant as it is because of the economic size and their participation in the global trade. Now, we have seen other economies rising, and the more they rise, it means people are also required to use their currency in exchanging and in trading, in invoicing and in accounting. And therefore, that will also take a part of the share of the dollar from the world. Now, what do we learn from all this, or what should be our main focus as Kenyans? So in the conclusions, we conclude by noting this in the next slide. Next slide, please. Just a minute so that the slides move to the next one. Emmanuel?
Yes, I've moved it.
All right. So, in conclusion, instead of countries focusing on why the dollar, or whether the dollar is dominating or not, the countries, and especially Kenya, and this is important because, like, if you're all Kenyans, or if you're Kenyan, you understand today being 25th of June, that 2 years ago, Kenyans had concerns against their government for not creating enough employment, for overtaxation, government intrusion in private lives, and all that, which led to unfortunately, death of many people, which the country has consistently used this day to remember that the US dollar is dominating. The important question is it's dominating. The important question to ask is what factors contributed to this? It has often been argued, forcefully so, that the US dollar dominates because they have more power, and this especially is directed to their military capabilities, and therefore it's almost as if they force the world to use the dollar. That is not true. Remember, their military power is backed by the economy. If the economy was to shrink, the military power would also shrink. So they do not hold the world hostage. It is the stability of their political space, the strength and the independence of the institution, their growth in terms of economy. They have grown over the years since 250 years when the US became the US. They they respect freedoms and what Adam Smith would call natural liberties. And of course, they have the goodwill in terms of contributing to global public goods. It's good to point out that the multilateral system, the ones that the world is trying to reform, and it's okay to reform it, was heavily backed by the US. So these factors are what contributed to the US dollar becoming dominant in the world. So if a country like Kenya, a country like China, or whatsoever country would want to have some level of dominance, then there are certain reforms and certain traits that they need to pick up. And we are convinced that Kenya should pursue economic growth by by deregulating some of Kenya is heavily regulated and political stability is very wanting. Freedoms, we've seen contravention of freedoms, and also participating in or contributing towards global public goods. And this can be seen with being a safe haven when people are running from the risk of political persecution in their country, which our country nowadays is not doing as good as it was before. So all these factors are necessary if any country would want to dominate. And the other thing that we learn here is that any country can dominate, its currency can dominate, but it needs to pursue strong and independent institution, growth, economic and political freedoms. Because it's upon people having confidence on their institution that they are willing to invest in those countries, to hold the currency of those countries as their own reserve, and also to use it in their trading and also invoicing. And as I finish, it's important and that the US government notes that it's not upon its military power that its currency has been dominating in the world. It's heavily because of its institution and support of global public goods. And the moment, and Paul Krugman has been arguing this, the moment that confidence is lost, the US dominance is also going to be eroded. And therefore, as I conclude, it's important to note that the conversation of de-dollarization is being done the wrong way. Countries should be asking themselves, how are we able to improve our institution? How are we able to pursue growth? And how are we able to contribute towards global public goods and the multilateral system to enable them become at least dominant or have a bigger share as far as their currency usage is in the world. So that will be the end of this, and we then open this space for questions. So in case you have a question, you can do it by raising your hand. You can type it in the chat box, and then we are going to respond from that end.
Thank you for the presentation. My name is Nzia. I'm a fourth year economics and finance student, and I've gathered a lot from the presentation. So I only had a small question. I was curious as to the extent in which the petrodollar system is linked to US dollar dominance. So, for instance, should the Middle East decouple from the petrodollar system, would this be a significant accelerator to dollar decline, or will it not be? I think that's it. Thank you.
Amazing. Thank you for the question. I think going back to the 1970s, 1971, actually, there was a petrodollar agreement that ensured all Arab states that were producing oil would price their oil in dollars. But I think nowadays, because of I think as demonstrated, but in the presentation, the dollar is used widely in all and traded in all commodities, not just oil. I think it would be less of a structural shock. First, because oil is a smaller scale of trade than it was in the 70s. Now like computer chips are almost as large or just as large as oil. But even if the oil were to be priced in a different currency, that doesn't necessarily hurt the US dollar. Oftentimes the buyer will redeploy that currency back into US dollars. So pricing oil in yuan or another currency wouldn't be able to create the same petrodollar agreement that we have. But thanks for the question.
Thank you very much.
Emmanuel, would you love to?
I think, sure. I think when you look at it from first principles and ask what is the petrodollar system, on the one hand, and think about what we laid down. Most people, I think, have an impression that there is no petro-euro because Europe was outsmarted by the Americans, right? And they have this impression that that's more evidence of something, more political decisions driving the dominance of the dollar. But if we ask ourselves just from first principles and look at the Saudis, right? And I'm saying this as someone who has yet to study the petrodollar in particular in depth, and also in answering why we didn't look at it that much in this presentation. So we can see that the reasons for which the dollar is dominant have less to do with political decisions than with institutional decisions, and that actually political expediency can erode the reasons, the underlying reasons for which the dollar is dominant. So the Saudis and everyone who's exporting, the major oil exporters, might continuously find it beneficial to receive dollars in return for the oil they sell, just first of all, for the reasons that we have highlighted before any other reasons. And if someone else wanted them to use an alternative, if, for example, Beijing truly, right, not for political imagery, wanted their currency to dominate the trade in oil, they would also have to make similar institutional changes, right? Change the institutional configuration. So, I mean, we'll give an example. You don't see Americans saying that they have a distaste for Islam, and so they're not going to buy any more fuel, or they're going to seize the American assets in the form of, say, treasuries that the Saudis have purchased with the dollars that they earn from selling petroleum, right? And that is important to note. It's not an insignificant factor. So I think we can say these are the foundations. Let me end my comment there.
Thanks, Emmanuel. Any more questions? I hope that fully answers you.
Yes, yes, I think it's clearer now. Thank you.
All right, thanks. Thanks for the question. Anybody else who would love to ask a question, give a comment?
Okay, I could give a quick comment as they prepare.
Sure.
We could also think about an analogy and say, okay, what if the Kenyans went to the Saudis and said, we want to buy petrol from you in shillings forever, and we don't want to pay for petrol in dollars. Let's make an agreement. Then the Saudis might ask, okay, what do you have to give in return? You know, if the Americans just implicitly, not explicitly, not like you give the minister of oil a jet so that he can buy some fuel in dollars. Even that might not be enough. But then the Americans can come in and say, and we're just speaking hypothetically, right? Buy, give us oil only in US dollars. And the Saudis look around, now we're talking about the present day, right? Not the 50s, but today. I mean, and so the Saudis might say, there's not a lot of places to park trillions and trillions of dollars that are better than the US Treasury bills. And we want to park this money. We can't throw it all into startups in Silicon Valley. But even then, we're thinking about Silicon Valley. We're not thinking about the Silicon Savannah. We don't want to throw money into in M-Pesa. M-Pesa has already maybe saturated and done what it can. That so-called innovate, extreme, you know, innovation without bounds, and the potential that they speak about this Silicon Savannah hasn't attracted the trillions that you might think it would attract if it was so in demand. Although it's maybe relative to other markets on the continent. So why is Kenya attractive relative to other markets on the continent? It seems to be our own institutional accomplishments. So we have a bit more, property rights safeguards are just a bit better than, say, Uganda or the Democratic Republic of Congo or South Sudan or Ethiopia to the north. And that our institutional mix, when you talk about a free market, rule of law, efficient regulation, we might not be scoring so high, but we seem to be, maybe we're doing a little bit better than others, and we are. Of course, this is a competition of dwarfs, but you see that even that thought experiment just demonstrates why other things must precede the offering to another country to say we only want to buy your commodities in this particular currency. And now, if you look at the trade in chips and computer chips, that exceeds the trade in petroleum in terms of both its value and its ubiquity, which means in the same way that petroleum is everywhere and it's everywhere you look, it touches every aspect of your life and is also extremely valuable trade and the most important trade in terms of dollar value in the world. It's already been surpassed once by the computer chips, and it will be in the future. But you don't hear about, you have a petrodollar, but you don't have a semiconductor dollar. But still, we are purchasing computer chips in dollars. So you put all that together and it tells you something, that those who talk about a petrodollar as the source of dollar dominance have a lot more reading to do, right, and specifically saying that somehow the world was forced by the Americans to buy petrol in dollars. Thanks.
Thanks, Emmanuel. From the look of things, we don't have comments or questions, and therefore I'll invite Benjamin to make his concluding remarks, and then I don't mind, and then Emmanuel will come in last. Benjamin?
I want to thank you all for coming to this presentation. I think just to wrap up my concluding marks in a couple of sentences is that neither the Treasury nor most economists believe that de-dollarization is a near-term problem. De-dollarization in reality is a marginal reserve diversification, not a replacement of the dollar. As we've gone through in the presentation, the dollar remains dominant because of a couple factors, including its robust institutions in which the entire world trusts, even as Moses was mentioning, private citizens trust the US dollar as stable, even those who on the outside claim maybe are anti-Western or believe that the fall of the dollar is happening. Most of those people also have their money stored in dollars. They understand that it is the safe asset. It is a safe investment that you know you will get back in 10 years. Not only is it institutions, but part of it is also incumbency advantage. They've enjoyed this privilege. The United States has enjoyed this privilege. They've exported trillions of dollars into the economy. And so at a certain point, if everyone else is using dollars and it is the safe, reliable currency, a producer will often price their goods in dollars just because it is easier. Thank you all for coming.
Thanks, Benjamin. Well, I would like to point out that, well, at the end of the day, if a country invests in ensuring they have political, social, and economic freedom, and therefore the institution become strengthened and are led to be independent, and also they ensure that their own contribution to the world is huge or at least significant, then there's a likelihood that they're going to dominate. And in that case, it's a call to especially Kenyan and those of us who are citizens of Kenya or policymakers or policy contributors in whatever way. We should ask ourselves the fundamental question that what would make us grow? What would make people trust in our currency? And then lay down those institutions, advocate for them, and also pursue and also encourage leadership through how we vote and all that towards that direction. Once again, thank you for joining in. We appreciate you being here. Thank you.
Yeah, thanks. Indeed, building our institutions is a counterintuitive way to dominate the world. And as it turns out, to truly have the instruments, the endowments that allow for dominance, one has to do the counterintuitive thing, which is to actually create institutions that expand political and economic freedoms. And that in the final analysis, efforts or to take the endowments of the society and to use them as instruments of now dominance in the negative sense. It's not only morally abhorrent, right? but it also impoverishes, and so it can erode even the very endowment that one generated through ensuring economic and political freedoms. And so we should be wary of seeking or trying to dominate others as a and thinking that expiation of emotions also leads to prosperity, because the evidence is that it does not. And the evidence is there for us even to see this very day, when large nations like Russia are oppressive domestically and invading others, so that on the aggregate they're just impoverishing everyone, even as they kill others. Thank you very much.
Thanks everybody for joining in. Feel free to leave us on. Thank you.